How do banks have enough capital to cover losses in times of stress? The Capital Adequacy Ratio, or CAR.
Do you have enough capital or cash to cover your expenditure? And is that cash available at short notice? Just like you, banks have to monitor the amount of capital that they have, and one of the ways that they can do this is via capital adequacy, and that's the amount of capital or shareholder money a bank needs to hold in order to ensure it has enough funds to cover losses and to remain solvent under times of financial stress. The amount of capital is usually defined by regulators and is measured using the Capital Adequacy Ratio, or CAR. That is your ratio of regulatory capital divided by risk-weighted assets. Regulatory capital, that can also be described as eligible or owned funds, depends on the quality of each type of capital, and there are three main types. Tier 1 capital is the highest quality, that absorbs losses immediately as they occur. Additional Tier 1 capital, that is loss absorption on a going concern basis, i.e. the business is still running okay. And Tier 2 capital is the lowest quality, and that is when there's a gone concern capital, so the business is now struggling and is not okay. The denominator, or risk-weighted assets, can be calculated via two different methods that are actually used to determine credit risk, i.e. the potential to default. There's a standardised approach and an internal ratings-based approach. Now, the standardised approach is used by most firms, and it's based on external ratings whereby each exposure is assigned a standard risk weight. Assets of higher quality, such as those with an AAA weighting, such as a government bond, will be assigned a risk weight of 0% or 20%. In contrast, covered bonds or mortgages would be assigned a lower risk weight, for example 35 or 40%. And there's been some reforms called Basel III reforms that have actually made proposed changes to the risk weights. The second approach, the internal ratings-based approach, is subject to the explicit approval of the bank's supervisor and allows banks to use their internal rating system for credit risk. The total capital ratio must be no lower than 8%, and it's reported using three templates. There's an own funds, which is the numerator, whereby you insert your capital, the amount of each type of capital. Then you also have a second template, which is for your denominator, which is your risk-weighted exposure, either by the standardised approach or the internal ratings-based approach. And then it all comes together on this final third template, which actually calculates the capital ratio for you.